Understanding the value of money. The yard measures distance, said the teacher. But what measures the yard, was the question. Well, came the reply, distance itself. Similarly, money measures goods. But what measures money? Goods is the reply. Value, as we know, is the ratio of exchange between two goods, and money measures that value through price. Money is an object of desire. Efforts are made to obtain it not for its own sake, but for the goods it can purchase. The value of money, then, is the quantity of goods in general that will be exchanged for one unit of money. The value of money is its purchasing power, the quantity of goods and services it can purchase. What money can buy depends on the level of prices. When the price level rises, a unit of money can purchase less goods than before. Money is then said to have depreciated. Conversely, a fall in prices signifies that a unit of money can buy more than before. What are three factors that determine the value of money? The three main factors that determine the value of money are exchange rates, the amount of dollars held in foreign reserves, and the value of treasury notes. The most important single factor determining the value of money is the basic rule of supply and demand. The more demand for a given currency or item, the more that currency or item is worth. That is especially the case when demand exceeds supply. Because every country maintains its own currency, and because the political and economic situation in each country varies, sometimes minutely and sometimes massively, the value of each country's currency varies accordingly. The less confidence in a particular currency, the weaker the demand for that currency and the lower its value. A second factor used to determine the value of money involves the amount of a given currency. We'll use again the US dollar for illustrative purposes, held by foreign nations in their central repositories, known as their reserves. Many countries maintain supplies of foreign currencies to hedge against radical shifts in exchange rates. China holds over $1 trillion in US debt, which it uses in part to keep the value of its own currency, the renminbi or yuan, lower than the dollar. It does this because its economy is highly dependent upon exports to large markets like the United States. A third factor determining the value of money is another extension of the fundamental principle of supply and demand: U.S. Treasury notes and bonds. The principle of a bond is simple. An individual or a foreign government buys U.S. Treasury notes or bonds that will mature over a specified period of time, at the end of which the note or bond can be traded in for a specified amount that includes interest on the original investment. Foreign and domestic purchases of U.S. Treasury notes, bonds, and bills influence the value of the dollar because the more such financial instruments are purchased, the more confidence those consumers and foreign governments have in the future of the U.S. economy. U.S. dollar and monetary policy of Federal Reserve System of U.S. Fiat money is a government-issued currency that is not backed by a commodity such as gold. Fiat money gives central banks greater control over the economy because they can control how much money is printed. Most modern paper currencies, such as the US dollar, are fiat currencies. Monetary policy refers to the steps taken by a country's central bank to control the money supply for economic stability. For example, policymakers manipulate money circulation for increasing employment, GDP, price stability by using tools such as interest rates, reserves, bonds, etc. Real-world examples. Let's look at some recent monetary policy examples from the real world. Amidst the coronavirus pandemic, the U.S. Federal Reserve lowered the benchmark interest rate close to 0%. Although the benchmark indicates the rate of interbank short-term borrowing, it affects the overall borrowing rate, including those for consumer loans. As such, this was an example of expansionary monetary policy which was adopted to avoid a money crunch. It also focused on bringing down unemployment numbers and economic slowdown. Another recent report talked about China's coronavirus stimulus program ending in advance as the economy showed an impressive recovery. The stimulus had involved lowering interest rates. What causes the US dollar to rise? The answer is to control inflation. As interest goes high, the interest rate of saving accounts, FT, also increased. Credit cards, home loan interest goes high. People invest more than spending. Circulation of the money goes down in the market, and demand goes down. As a result, price comes down. There are a variety of factors that cause the US dollar to rise, but the primary factor that it boils down to is demand for the dollar. If the demand for the dollar increases, then so does its value. Conversely, if the demand decreases, so does the value. The demand for the dollar increases when international parties, such as foreign citizens, foreign central banks, or foreign financial institutions demand more dollars. Demand for the dollar is usually high, as it is the world's reserve currency. Other factors that influence whether or not the dollar rises in value in comparison to another currency include inflation rates, trade deficits, and political stability. Slowing growth of US dollar. A variety of economic factors can contribute to depreciating the US dollar. These include monetary policy, rising prices or inflation, demand for currency, economic growth, and export prices. Strong economies tend to have strong currencies. Weak economies tend to have weak currencies. Declining growth and corporate profits can cause investors to take their money elsewhere. Reduced investor interest in a particular country can weaken its currency. As currency speculators see or anticipate the weakening, they can bet against the currency, causing it to weaken further. I hope you enjoyed watching this video. Like, share, and subscribe for more interesting videos like this. Thank you.